Hey, Morgan. So Amazon's founder and former CEO Jeff Bezos to sell another 0.5 million shares. That's according to, or $1 million worth of shares. That's the dollar amount.
$4 billion. 3 founders. 180 days. Between November 2025 and April 2026, 3 of the most successful technology and media operators of the last 25 years quietly extracted approximately $4 billion from their own companies. Jeff Bezos at Amazon, Peter Thiel at Palantir, Reed Hastings at Netflix. The architects of modern technology were converting paper wealth into hard cash. This is not opinion. This is forensic SEC Form 4 data. And it is happening at the exact moment the Buffett Indicator has reached a level Warren Buffett himself never warned about, because it had never happened in financial history. Today I will walk you through the exact transactions, the legal mechanism that allowed this at the precise top, the historical parallels to 2000, 2007, and 2021, and what these founders saw in November 2025. Let me show you the data. We begin with the macro environment. In January 2026, the aggregate insider sell-to-buy ratio across all U.S. corporate insiders climbed to 4.83. For every dollar of equity bought by an insider with personal capital, $4.83 was liquidated. The historical contrarian threshold is 3.5. This level is statistically rare and historically associated with late-cycle market tops. Then, the Buffett Indicator. Total U.S. corporate equities divided by GDP. With the Q4 2025 GDP second estimate, this metric reached 232.6%, the highest level ever recorded. Buffett's verbatim warning from his December 2001 Fortune essay, quote, "If the ratio approaches 200%, you are playing with fire," end quote. We are 32 percentage points above his explicit danger threshold. This is the atmosphere in which Bezos, Thiel, and Hastings executed their extractions. CEO number 1. Jeff Bezos at Amazon. Bezos adopted a Rule 10b5-1 trading plan to liquidate up to 25 million shares of Amazon over a window ending May 29, 2026. Those shares represented approximately $4.67 billion in notional value. Execution accelerated in November 2025 when a single regulatory filing revealed a transaction block of more than 16 million shares, liquidating over $3 billion in equity. $3 billion. As Amazon stock neared the resistance level of $200 per share, the highest split-adjusted valuation since the IPO in May 1997. The block hit the market at the exact moment retail and passive index flows were peaking. Through Q1 2026, Bezos's broker algorithms continued executing smaller rolling tranches under the same plan. Despite liquidating over $3.5 billion in this window, Bezos still retains over 880 million shares, and his net worth has held between $220 and $239 billion. Between the March 2022 and September 2025 quarters, Amazon's fully diluted shares outstanding rose 5%, from 10.3 to 10.8 billion. The buyback program failed to offset stock-based compensation dilution. Wealth is being silently transferred from public shareholders to founders. CEO number 2. Peter Thiel at Palantir. On March 2, 2026, a single Form 4 filing detailed Thiel selling exactly 2 million shares of Palantir Class A common stock in open market trades. Weighted average prices ranged from $140.67 at the low up to $147.137 at the peak. Total cash extracted in that single session, $280 million. The forensic detail. The shares were held by an entity called STS Holdings, 2 LLC, for which Thiel was sole beneficial owner. By selling those 2 million shares, Thiel completely zeroed out that direct holding vehicle. He retains massive indirect exposure, but he eliminated one entire holding entity in a single day. Here is the line in the Form 4 that tells you everything. The trades were executed pursuant to a Rule 10b5-1 plan adopted on November 14, 2025. Thiel made the decision in mid-November 2025. At the exact moment retail euphoria was peaking and the AI infrastructure trade was at its most enthusiastic. The execution date was the legal release valve. The decision date is what matters. Why does that matter? At the time of the sale, Palantir was trading at a price-to-sales multiple of 77.4 times. with an enterprise value of $339.4 billion, a valuation that requires flawless execution for the next decade. Thiel, the architect of Founders Fund and Thiel Capital, surveyed that valuation and quietly extracted $280 million in cash. CEO number 3, Reed Hastings at Netflix. Through the early months of 2026, Hastings executed a structured campaign of stock option exercises followed immediately by equity sales. According to his Form 4 disclosures, Hastings generated approximately $135.9 million in liquid cash from Netflix stock sales in 2026 alone. This is the tail end of a broader liquidation that has now totaled $505.9 million beginning in early 2025. He exercises long-held, deeply in-the-money options, immediately converts the shares into cash on the open market, and shifts the wealth out of Netflix's corporate structure into his private family office. This is happening alongside strong fundamentals. Netflix surpassed 325 million paid memberships globally in 2025. Revenue, $45.2 billion, up 16% year-over-year. Operating margin, 29.5%. The advertising tier more than doubled to over $1.5 billion. So why is Hastings cashing out while the numbers are this good? Because there are only so many broadband-connected households on the planet. A court in Italy recently ruled some of Netflix's pricing terms and past price hikes were unlawful.
And Reuters is confirming that the Italian courts have ruled that the Netflix price hikes are illegal.
He said, not today.
Not today.
Hastings is also stepping off the board at the June 4, 2026 annual meeting. The cash extraction and the governance exit are simultaneous. Now to the legal mechanism that allowed all 3 executives to extract billions at the exact top without triggering insider trading investigations. SEC Rule 10b5-1. Originally established to give corporate insiders an affirmative legal defense against trading on material non-public information. If an executive files a binding plan specifying the amount, price, and date of future sales when not in possession of inside information, they are shielded from liability when the trades execute months later. The rule was systematically gamed for over a decade. In December 2022, the SEC implemented sweeping reforms that took effect February 27, 2023. The most critical element was a mandatory cooling-off period. Directors and executive officers are now subject to at least 90 days or until 2 business days after disclosure of the issuer's quarterly financial results, whichever is longer. This is the mechanical key to the entire Q1 2026 forensic signal. When Peter Thiel's 2 million shares hit the market on March 2, 2026, the public viewed it as a Q1 event. Due to the cooling-off period, Thiel made the irreversible decision on November 14, 2025. The true contrarian signal is the adoption date. The volume of 10b5-1 plans adopted in late Q3 and Q4 2025 indicates the smartest operators surveyed the 230% Buffett Indicator and established a protected legal runway for extraction. Now to the patterns these 3 operators share. First, sector and valuation concentration. All 3 executives operate at the nexus of technology, AI, and megacap growth. All 3 companies trade at the upper standard deviations of historical valuation metrics. Palantir at 77.4 times sales. Amazon at the highest stock price in 28 years. These are not normal valuations. Second, timing concentration. The executions clustered around earnings beats and all-time high retests, using periods of maximum retail liquidity as exit liquidity. Bezos' $3 billion November 2025 tranche aligned perfectly with Amazon's highest split-adjusted price since 1997. Founders are using passive index inflows as their exit window. Third, wealth concentration risk mitigation. Even for deca-billionaires, modern portfolio theory still applies. Founders eventually reach a threshold where holding 90% of their family's net worth in a single volatile equity is mathematically irresponsible. Selling at a 230% Buffett Indicator peak is not panic. It is rational risk mitigation. Now the bullish pushback, the corporate buyback offset. The argument: if a CEO sells 2 million shares but the corporate treasury buys back 10 million, the net float is shrinking and the CEO sale is routine noise. That thesis fails on 2 fronts: mathematics and signaling. Empirically, the buyback offset routinely fails, as shown with Amazon. 5% dilution despite billions in buybacks. Stock-based compensation issuance during the AI talent war consistently outstrips the retirement of shares. The signaling disparity is profound. Stock buybacks are a corporate decision using public shareholder cash. Insider sales are a personal cash decision. When a board authorizes a buyback, it creates an artificial bid. When the founder simultaneously unloads $3 billion of personal stock into that bid, the founder is using shareholder-funded liquidity as a guaranteed exit. The buyback is paying for the founder's escape route. Now, to the institutional confirmation, because executives are not the only smart money retreating from this peak. Berkshire Hathaway, in Q1 2026, executed $24.1 billion in net equity sales. The cash pile reached an unprecedented $397.4 billion. That is 14 consecutive quarters of Berkshire as a net seller. Greg Abel ran his first annual meeting as CEO in this period. Buffett, endorsing the strategy, said verbatim, quote, "The market is in a gambling mood," end quote. Then Michael Burry, the investor who forecast the 2008 subprime crisis. On November 10, 2025, just 4 days before Thiel adopted his 10b5-1 plan, Burry deregistered his hedge fund Scion Asset Management with the SEC, stepping away from 13F disclosures. But his terminal options data revealed his parting trades. 50,000 Palantir put options expiring January 2027. 10,000 NVIDIA put options expiring December 2027. He identified the AI capex bubble, positioned heavily short, and went dark. The pattern is now unmistakable. 3 founders extract $4 billion. Berkshire raises a $400 billion cash position. Burry takes massive bearish bets and shuts off public reporting. This is what late-cycle smart money looks like in real time. Foundational work by H. Najat Sehun established that insiders sell for many reasons, but they only buy for one. They believe the stock is going up. Coordinated selling by multiple founders at extreme multiples has exceptional predictive value. In 2000, dot-com executives sold at 100 times revenue. In 2007, financial sector CEOs liquidated before subprime contagion was acknowledged. In 2021, SPAC sponsors unloaded billions before that market collapsed. The Q1 2026 signal fits the pattern. Here is your 3-step takeaway. First, recognize the signal, not the execution date. The signal is the adoption date of their 10b5-1 plans in Q3 and Q4 2025. That is when they made the irreversible decision to extract billions at the most expensive valuation regime in financial history. Combined with the 4.83 sell-to-buy ratio, the $400 billion Berkshire cash pile, and Burry's positioning, this is the most concentrated late-cycle insider signal in 25 years. Second, examine your own portfolio concentration. If your retirement account is concentrated in the same magnificent 7 names that Bezos and Thiel are exiting, you are now on the opposite side of their trade. They are diversifying out at the peak. Consider whether you are diversifying in at the peak. The math of position sizing is identical at any wealth level. Third, stress test for the catalyst calendar. The Section 122 tariff replacement expires July 24, 2026. The AI capex ROI scrutiny moment arrives in late 2026 when Wall Street demands tangible software revenue to justify hundreds of billions in hardware spend. None of these catalysts are priced into a market trading at 232.6% of GDP. The founders extracting $4 billion recognize the asymmetric risk is no longer worth the marginal upside. If you want to see exactly which insider transactions are filed every week, the SEC Edgar system publishes Form 4 filings within 2 business days. The Washington Service, Insider Insights, and SecForm4.com aggregate the data. The information is not hidden. The discipline to read it is what is rare. I am not a financial advisor. This video is for educational purposes only and is not personalized financial, tax, or investment advice. Past performance does not guarantee future results. The strategies and securities discussed carry significant risk, including loss of principal. Always consult a qualified professional before making decisions about your specific situation.